Hi guys, welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita, Khemka, and a very sad looking.
Hello there, I'm Yatin, Mota. I'm not sad, but yes, the market setup seems so. Nandita, Nandita will start. Typically, you were saying it was a terrible Tuesday.
Traumatic Tuesday for the bulls.
Tuesday. It is probably a thundering bear Tuesday. But yes, Nandita, clearly the last half an hour of the markets were very brutal. Almost 300 points down on the Nifty.
That's true, Yatin. In fact, we've kept up with the trend of starting off the day on a positive note, but all of those gains were completely reversed, and of course the sell-off only deepened in the last half an hour, as Yatin was mentioning. So we are almost 300 points down, even broken below that 23,900. So major support levels getting taken out. Now I'm sure a technical analyst will say that 23,800, 23,750. These are the kind of levels that we'll be watching out for at lower levels. And I was talking to Ambrish Baliga in the morning on our opening show. He sounded very circumspect. He said that we already 2,000 points off record levels, and going forward, you never know how deep this sell-off can get. So it's apparently time to just take some profits at higher levels and sit on cash. So that's the kind of sentiment I've gauged from the kind of conversations I've had with market experts. And if you look at the broader end of the markets, also Yatin, no respite there. Yesterday as well, the Nifty mid-cap index saw a 1% cut. Today as well, both the Nifty mid and small cap indices have seen cuts of over 1%. Breadth was of course dismal. NSE Advance-Decline ratio was almost 1:3, and almost all the sectors ended the day in the red. Banks of course took a hit. It was expiry for the Nifty Financial Services Index today. And PSU Bank Index also shed somewhere around 2%. The Nifty Bank Index below 51,200. Autos, metals, these are some of the pockets that saw heavy selling. But I think IT, did some bit of damage control. But still, I think it also ended largely flat. Aside of that, if you look at some of the individual movers, Yatin, Britannia, that stock at over 5-month low. Of course, management commentary was being digested by the street. Numbers also not very enthusing, although volume growth wasn't all that bad. But Bharat Electronics, NTPC, HDFC Bank as well today, Yatin, among losers. Asian Paints continues its downward move. SBI as well under pressure today. So some of the tech names, of course, once again emerging as gainers, the likes of Infosys, HCL Tech. But RIL also slim gains, but it was trying to hold out throughout the session. Trend, of course, continuing its upward move since yesterday. But Yatin, broad end of the markets, quite a few movers there as well.
Quite a few movers, but it's a mixed day for the mid-cap index because if you look at the advanced decline ratio, it was almost turning out to be 5:1. 1:5, which means one stock gaining for every 5 declining. And if you look at the mid-cap indices, more than 1% losses coming in there. What was doing well post numbers is Uno Minda. That stock was 9% higher. Jubilant Foodworks post the management commentary that growth is something which they will focus on. Despite dismal margins, we have seen the stock up 6% in trade. Ramco Cements and Lodha were the other stock which gained 5% in trade. What was not doing well is Basaf, post the numbers down 15%. ITI, some profit taking there, 10% down. Jyoti Laboratories as well as Akums, this is one of the new listings. Both of these stocks down 8 to 10%. Clearly, one trend, Nandita, in the entire result season is that urban consumption is slowing. FMCG players are finding it difficult to get volume growth, be it Asian Paints or be it Hindustan Unilever. I think the big stalwarts of the FMCG industries are facing some headwinds, be it Titan. The numbers were not that great, and if you look at the overall oil and gas sector or probably the macrofinance sector, it has been a washout quarter for all of them, and probably because of dismal Q2 earnings, I think the markets also has accelerated the speed of the correction.
That's true, Yatin. Focus on domestic earnings. That's why even though we have good global cues to work with, in the morning, we kind of have decoupled for now. You can say that. But aside of that, as you were mentioning, urban slowdown emerging as a trend when it comes to FMCG names. Britannia being no different, although volume growth has been maintained at 8%, vis-a-vis expectations of 8 to 9%. Second straight quarter of 8% volume growth, but revenue profit below estimates. There was a one-time hit on the back of stock appreciation appreciation rights expenses, staff expenses, which was around 50 crore rupees or thereabouts. It was although a one-time expense, but still it did weigh in on earnings. Gross margins also came in lower at 41.5% vis-a-vis 42.9% on a YY basis. Of course, the management has pointed out that they are seeing a very tough demand scenario in the urban areas, of course, coupled with high inflation. Value growth of the FMCG pack is in fact falling with input cost inflation rising. Management mentioned in its con call as well. The company has already taken a price hike across its portfolio, but it will be doing so once again, maybe taking resort to a 4 to 5% kind of a price hike across its offerings. But it is likely to take further price actions to maintain its margins, correct, not really to boost it, but to maintain it. And of course, it will be gradual across December and January. The management also pointed out that commodity inflation has been a lot bigger than what the company was anticipating. They've also mentioned that there will be a few players who will not really take recourse to any kind of price hikes to maintain volumes, but once they realize that their profits are getting eroded, they will take knee-jerk reactions, and that will erode their profitability further, and of course that will also result in volume loss for them. But management has mentioned that as a result of the price hikes that they are anticipating, there will be a short-term impact on volumes. But of course, they will try to balance out volume and price growth, and they will watch out for the situation very closely in the next 6 to 9 months. The company is also saying that the key reasons for urban slowdown would be rising housing costs, as well as slowdown in the wage growth of the non-salaried class. So these are some of the factors, according to the management, that is impacting urban consumption. The strategy here on would be to focus on driving market share while sustaining their profit growth. That was highlighted, but of course they have pointed out that demand scenario is not as robust as it used to be in the past. But looking at what the brokerages are saying, Morgan Stanley has maintained an equal weight rating. Target price is at 5,424. They've pointed out that inflation has hurt demand and profit, and it's a miss on all fronts. And they also see a downside risk to the guidance that the management had given earlier, where they had said that revenue growth will be in line with the volume growth. That hasn't really happened. Nomura as well, they have a neutral rating. Target price is at 5,800 rupees per share, and they've also noted that earnings have been below estimates. But stock, of course, today at over 5-month low, and even on a YTD basis, it has turned negative. Yatin.
Absolutely, and that is the story of most of the FMCG stocks facing some headwinds with terms to growth. But UPL, this is one stock we need to watch out for. Yesterday corrected more than 6%, in fact went down as high as 9% in trade. Today moved 4% higher, one of the top gainers in the F&O segment. And the reason being that management sounded confident when it comes to the guidance for FY25. In fact, UPL has affirmed its FY25 guidance despite posting a weak Q2. They expect that second half will be quite good. In fact, Q3 onwards, which is the third quarter, we could see some momentum on the margin side. UPL also sees a revenue growth of nearly 4 to 8% in FY25 with an anticipated growth of nearly 50% at the EBITDA level, which is the operating profit. Now, HSBC has a buy call on UPL. However, they have cut the target price to a level of 680. Despite the cut, we can probably see a 30% kind of upside in the share price of UPL according to HSBC. They expect that second half could see some good improvement, and rights issue as well as other initiatives are the lever for debt reduction moving ahead. So I think the markets probably liked the way management will deleverage balance sheet, will perform better in H2, and that is the reason why after yesterday's painful downtick, despite weak market conditions today, the shares rallied more than 4% in trade.
That's true, Yatin, but I think the revenue beat was more than offset by a miss in margins, and their margin performance will have to improve significantly if they have to meet the guidance that they have given in the con call. But on that note, there's another stock that rallied quite a bit on expectations of a good second half. That's Ramco Cements. That stock, managed to hold out in a weak market, gained somewhere around 5% or thereabouts. Shares hit a 9-month high. Profit although saw a 75% fall on a YY basis, but expectations were that the company will hand in a loss of 10 crores. So that way it was a beat. Revenues also came down by 12.5% due to a drop in cement prices. Of course, subdued demand, falling prices, These are some of the factors that impacted cement numbers this time around. So Ramco was no different. Volumes also saw a marginal degrowth of 1% due to weak demand on back of extended monsoons, heat waves, election related delays as well. Of course, the company has also repaid debt to the tune of 320 crore rupees or thereabouts using the proceeds of a sale of its non-core assets. It has also entered into a sale agreement for disposal of lands worth 74 crore rupees, and that realization will happen in the third quarter. So the third quarter earnings may get a boost because of that. Second half is expected to do well as demand recovers, and of course the election related delays are behind us, so construction activity will also pick up. So that way I think analysts are also expecting pricing power to come back in the second half, which is some reason to cheer for cement names as well. Let's take a look at some of the brokerages as to what they have to say about some of these cement names like Ramco. Jeffries has an underperform rating. Target price has been cut to 680 rupees per share. They've said that the leverage ratios still remain elevated, and Q2 EBITDA was better than estimates on the back of lower costs. ICICI Securities, on the other hand, is saying that demand will pick up in the second half in the southeast regions in H2. Of course, operational performance is likely to improve because the company has seen operational efficiencies, and that is expected to continue. Of course, the company is also looking to expand capacity to 30 million tons per annum by FY26 from the current level of 24 million tons per annum. So these are some of the factors that will drive growth in the second half, and monetization of non-core assets will continue in the second half as well, and the proceeds from that will be used for capex as well. So these are some of the factors, but there is heightened competition in the south, right? Because we've seen major cement players acquiring smaller cement companies. There's been consolidation, so there will be competitive intensity for some of these cement names. And of course, we'll see how that really plays out. But for now, there are hopes of pricing power coming back, and cement prices also seeing some bit of an uptick in the second half, which could lead to better realizations for cement companies.
Absolutely, and the stock of Ramco almost near the day's high, so no big impact on the markets, and a good move of nearly 50 rupees on that particular stock.
That's true. I think before we wrap up the show, just want to mention some of the cues that we will be watching out for in tomorrow's session. First is October CPI data. Some macro data expected to come out at 4 p.m. because the timing has been changed from 5:30 p.m. to 4 p.m. October CPI seen in excess of 6% this time around, given the fact that food inflation continues to rise, although core inflation has kind of bottomed out.
Correct.
IIP numbers will also come out, and they are expected to be much better than what we saw in August. Some numbers to watch out for tomorrow, Yatin, will be Eicher Motors, Apollo Tyres, Vodafone Idea. These are some of the earnings that will come out tomorrow, and key Fed speakers will speak overnight, which would give us clues as to what the Fed really plans to do in light of the US election verdict as well. So lots to digest tomorrow as well. But for now, of course, we will be thanking you for joining us and watching the show. Have a great evening, and come back tomorrow morning on opening bell, where we take up all your queries as well. But for now, it's a goodbye from me and Yatin. Thanks a lot for watching.